All right, so now hopefully you see why I love the GNMA, all right? So let's take a look here. So the markets are down, what, 1.5 to 2% yesterday between NASDAQ and S&P 500. I don't pay much attention to the Dow because the Dow is just 30 stocks. It doesn't matter. S&P 500 and the NASDAQ. Anyway, all right, so the market is down 1.5, 2%. Wellesley was down 0.1%. Wellington was down 0.75%. GNMA was flat. Interesting. So as we sit there yesterday and we say, I'm retired. I got my Wellington fund, which is what, look, here's the way you should have it. You should have 4 years in GNMA and the rest in Wellington. It's just that simple, man. But that's not what you used to say. Yeah, I've changed my opinion a little bit. I mean, look, I will probably have 4 years of GNMA and the rest in VTI. I think. But safe precautions with having some corporate bonds in there and some high yielding bond or higher yielding bonds in terms of longer duration bonds and things of that nature for the Wellington, that makes sense to me. So 4 years in GNMA and the rest in freaking and the rest in Wellington. It's just such a perfect portfolio, man. I tell you, it's so simple. Keep it simple, stupid. And then on top of that, you got hold on a second, let me just negotiate this turn here, make sure no one's coming. So you got 4 years in GNMA. So when the markets are getting hammered, like what happened the last couple of days, if you need some money, you just pull it out of GNMA. And then when the markets go up, you take it out of Wellington. It's just that simple, man. Now, hopefully you don't do this every week. Hopefully you're just doing it once a year, man. You know, that's why I tell people all the time. I say, should I take it out once a year, every month, every quarter? No, just once a year. Be done with it. No, just look. Now, I like things simple. I'm a simple guy. I'm a caveman. Remember Phil Hartman? I'm just a caveman as he's driving his BMW. It's pretty funny. From Saturday Night Live, Phil Hartman was the man. Troy McClure here. You might remember me as, oh my goodness. Anyway, so what, dude, what are you doing? You pull in front of me and then you putter along? That was kind of weird. Anyway, going back to GNMA. So this is the issue. When the markets go up, GNMA may or may not go up. When the markets go down, GNMA may or may not go down. But usually it just is flat. If you look at the history of the price of the GNMA, I think Vanguard introduced GNMA in 1980. And if memory serves, they introduced that at $10 a share. So that's a NAV, the net asset value, basically a share price. It's basically $10 a share back then. Is hovering around $10 a share ever since. A couple times it got over 11, a couple times it got under 9, but not very often. And it just hovers around 10, excuse me. I think it's like 10.54 or something like that. It's such a great fund because you're sitting there, just, you know, at the end of the day, the GNMA is going to give you a little bit of income. Not much, but certainly more than a cash account. Certainly more than certificates of deposit. And by the way, GNMA, it's liquid. And if memory serves, you used to be able to write checks against GNMA. I don't think you can anymore, but I think you used to. When I was at Vanguard in the late 90s, I think you could. I'm sure those days are no longer. But, you know, Frank, I don't know. But anyway, the point being is that GNMA, it allows you liquidity where I think it's T+1, that you have your money the next day or so. I can't remember. But pretty doggone quick, if that makes sense. Now, the drawback about GNMA, but what about the reinvestment risk? So what happens, what that simply means, my friends, is that when you're buying the GNMA, you're buying mortgages. So my mortgage, actually, I don't think I have a VA mortgage anymore. When I did, though, the Veterans Administration, the GNMA, the Government National Mortgage Association, guaranteed Pentagon Federal Credit Union that I'd make good on my debt. That's the GNMA. The GNMA is a government entity. It's literally GNMA.gov. It's a government bond. It's not Fannie Mae. It's not Freddie Mac. It's GNMA. It issues mortgages. That's what it does. I should say guarantees mortgages. It's fantastic. Anyway, long story short, so what happens is when the interest rates go up, I'm not likely to refinance my interest, if that makes sense, my debt. And so basically, if I got a GNMA that guaranteed my note to Pentagon Federal Credit Union is paying, let's just say 3%, if interest rates go up to 4%, I'm still going to get, well, you're still going to get 3% on the bond because you lend it to me at 3%. I'm not going to refinance my mortgage, so you'll still get 3%, where other bonds out in the market are paying 4%, if that makes sense. And so that's called reinvestment risk. You're reinvesting at a low interest rate, lower than what you could have done if you weren't locked into intermediate term, long-term debt. Okay, not that big of a deal. People buy and sell houses all the time. So I find that to be way overblown. If you look historically, how many times do you turn over your debt, your mortgage each and every year, each and every time you live in your house? Quite a bit, actually. And so how many houses have I bought? How many mortgages have I had? None of them have held for 40 years or 30 years. None. You know what I'm saying? And I imagine you're the same way too. So basically what happens here is you're like, dude, all right, I get the idea of reinvestment risk, that I'm only going to pay 3% to you, the bondholder, when mortgage rates now are at 4%. But I sell my house, I refinance, I cash out the whole thing. People just move. It's just not as, I don't know. I just think that's way overblown, the reinvestment risk. Now, part 2 of that is also refinance risk. The interest rates go down. So I was getting 3% on a 30-year GNMA bond. Now I'm refinancing my debt. Instead of paying 3, I'm paying 2. So now you get lower interest rates. So I call that refinance risk. That, I'm more likely to refinance my debt. So instead of paying you 3, because you own my GNMA, I pay you 2. All right, well, still, that's in terms of what other bonds do, that is completely different than the bond structure where they go up and down based on a short-term change in the interest rates. GNMAs don't have that as much because they're longer-term bonds. Like I said, 7 to 15 years is the average maturity on these bonds, and they're pretty locked in, pretty solid. So there is a little bit of reinvestment risk, a little bit of refinance risk. I don't think that's that big of a deal at all. And also, top of that, they're also issuing new debt as well. So if the interest rates go up, as bonds get paid, as bonds get refinanced, the new rates are going to be pay you accordingly. As interest rates go down, people still keep their older ones. They don't all refinance all the time. So you'll start seeing a slow depreciation on your interest rates, but it doesn't happen overnight. And just like any bond, as interest rates go down, the price of the bonds go up. Not much in GNMA, but that can still happen too. The point being, none of that matters to me because I look at it as my cash reserve. It literally is like, I still want you to have some money in literally liquid cash, FDIC insured cash. But at the end of the day, the GNMA, the best thing about it is like, all right, I'm sitting there tight, GNMA. I got a couple, $1,000 in my checking account. So if the roof goes out, I can just pay that, whatever. But with GNMA, it's sitting there just ready to be tapped into when the markets go down. I need some money. It's without much of a risk at all. It's a government debt. It's actually less risky than FDIC. FDIC is a Federal Deposit Insurance Corporation. FDIC is less guaranteed than a government debt, man. That's all there is to it. And so if it's government guaranteed debt, that is more backed than FDIC. Oh, and by the way, government guaranteed debt, there is no $250,000 limit on it either. So anyway, that's why I love GNMA. Yes, it was a perfect example of why you should look at GNMA as well. All right, we'll see you.